All right. Apparently the big news out of our last webinar, which was on Friday, which talked about buying call flies because of the expiration dynamics and the opportunity for volatility to crush to send the S&P higher. That was a good webinar, but I said Matt Damon for all right already, which is obviously incorrect. It is not Matt Damon, it's Matthew McConaughey. How dare I confuse the two? But anyways, that was the big reflection back to me. Not the great content, not, oh my God, this gamma stuff is just the most interesting stuff ever. Now look at what HIRO showed us, not the huge order flow, but it's not Matt Damon, it's Matthew McConaughey. So we've, let me set the record straight on that. What is happening today? Today is Monday, and we are here to talk about Black Friday. As you can see down over here in this area of the screen, we are having an amazing Black Friday sale today. Black Friday now is like, it starts, I don't know. It's like Christmas starts in Halloween and Halloween. Anyways, go over here, spotgamma.com/Black Friday. You get 75% off Alpha. Alpha is our #1 membership. You can see how interesting it is based on the screen over here. Well, I can't point to it anymore. But this is going to include all of the tools that I'm talking about today that helps us to analyze the options market. So try that out. The best deal that you can get that I've seen kicking around over here. All right, so what's going on? We got a couple of minutes here to give an update, and then we have our subscriber webinar at 1 p.m. If you sign up right now for Black Friday, you can join the subscriber webinar at 1 p.m. where we're going to be talking some more advanced stuff. And shout out to the Scott Pulcini crew if they're hanging around. We did a webinar for that group this morning, and we were talking about why this market may rally to 6,700. And luckily for me, as I was sort of pushing that narrative, we did rally up in the aforementioned 6,700 level. Based on the data that we see here, we can walk through why that is or how that all works. Again, this is Trace. Trace is part of the Alpha membership. So at the SpotGamma Black Friday page, you can get access to this tool. All right. So what is happening? Number one, let's talk about let's talk about hindsight. Let's talk about the foresight I had in hindsight. The overall map, which Trace shows us, is red, and this is from Friday morning. I write these founders notes every single day, and I have since January 2020. Never take a single day off. My wife has not been happy about some of the times I've had to write morning notes. That's life. All red. What does red mean? Negative gamma. It means price can move in both directions wildly. And a lot of you are saying, well, the VIX is above 20, so that's not terribly shocking. But what is shocking is the amount of volatility when you combine that with the negative gamma. Now, those two things intersect. What you're seeing here is our compass tool. We just launched an update to our compass tool a couple of weeks ago. And what you see here is that if we're on the left of this screen, puts are rich relative to calls. So Google, AMD, Amazon, Apple, etc. Puts are rich relative to calls. These are 1 month 25 delta puts versus the price of 1 month, or implied vol, of 1 month 25 delta calls. So if we're on the left, that tells you that people are bidding puts, not so much into calls. Okay, so what do you take away from that? Puts are pretty expensive. Now, this is the last year of data, so you have to remember like the tariff tantrum in April where the whole global financial system nearly seized. It's an accurate statement. So you see that whole thing seizing up, and this is, as far as put prices go, put values go, we're about as expensive as then on a put versus call price basis. Now, in April, the implied vol, in other words, how high the vol was way up here, kind of end of days. So puts, overall options were more expensive, but still, in terms of, put, love, call, hate, it's about as extreme as it goes. So you're already pushed to that extreme. And then you're going to hit the weekend. And you hit OPEX clearing out a bunch of puts. As you can see in this thing here, we were very heavily skewed towards puts. We covered all this on Friday. You can go and check those out. You check out the OPEX effect video from earlier as well. There's a whole bunch of content around that. So I'm talking about forward. So, okay, puts are expensive. What do you generally not want to do? You don't want to generally buy things when they're expensive. That's a good rule, general rule of thumb. Things that are expensive can't always get more expensive. That's the trap, obviously. But generally speaking, if you didn't buy like an IWM or a MicroStrategy put before Friday, buying after Friday, you're like, probably not such a great idea, right? So puts are very expensive. The VIX was at 21, 25, I think it was back then. And so we were talking about the fact that the trade here that we like. So what is the trade? We like the SPY or QQQ 1x2 broken wing call flies. We broke all this down on Friday why we like those trades as well. And the deal here is this. I explained this in the morning founders note, but it's the advanced logic of why, if there is a trade, we want to position into call flies. And yes, today those call flies are working out. We'll see how this breaks down. But guess what? Momentum is now with the bulls, at least through the next couple of days. Why? Because everyone wants to go eat their turkey, right? I mean, some of you are not in the United States, and so you don't have to have turkey. But in solidarity, you can imagine eating turkey. I don't even like turkey that much, but I like the day off. It's nice. Okay, so why does Thanksgiving matter? Why were we saying, look, we want to lean long with stocks above 6,600 in association with what we just wrote about that 1x2, right? That was the dynamic that broke down this morning. If VIX is at 25 and you have puts as expensive as they ever have been, or not ever have been, but put prices relative to calls are as expensive as they've been, you need something to happen to drive more downside. Implied volatility, VIX 25 is not like, okay, it's not VIX 40, but you still need downside energy, right? You need market movement to sustain that volatility. You need, it's like you need oxygen to breathe. It's like if you get cut off of oxygen, you're dying. Well, if you don't get the movement, VIX is going to die. Vol is going to die. What happens when vol dies? Puts get crushed. Those VIX calls get crushed, and then that leads to short cover. That's this Vanna flow that is important. So we put in this very basic options 101 document. This is from the optionseducation.org. Michael, I like stuff in engraved too. That's what I'm here for. Shout out to my mom. My mom, Costco pumpkin pies. She that's all she cares about. I think she'd trade me in for some Costco pumpkin pies. Anyways, moving on. Theta versus volatility. So another way to think about this is when VIX is at like 60, right? Okay, let's say VIX is at 40. Okay, VIX is at 20. Okay, what does this matter? The theta is higher for higher levels of vol. As vol comes in, as IV drops, as VIX drops, theta decreases. So why is that interesting? Because when you have VIX at 25 and record put versus call prices, or not record, but highs and puts versus calls, then the theta or the decay of those products or options, I should say, is very high, right? So we go through the weekend, we open up on Monday, and what's the news? Nothing, right? The pies are good, boosted. Then what happens? All right, we have a couple of days, but guess what? We're all going to stop caring all that much about trading Thursday for sure, and Friday's Black Friday, so you're all going to be looking at some other deal because you already took this Black Friday deal from SpotGamma and you locked in very cheap prices. Boom. This is as good as anything you'll find on Amazon right now. Trust me. And whatever you find on Amazon will not add as much alpha. It's a double entendre. So you have this decay. The decay is going to go over the weekend, the long weekend. It's essentially a 4-day weekend, right? No, who shows up on, I'll be here on Friday writing some notes and whatever, but ultimately, whatever. And I think the seasonality, for those of you who love seasonality, I think Black Friday tends to be a very bullish day. You have to fact check me on this, but I don't think ever in the history of Black Fridays has there been a down market. I'm a little bit skewed on guessing that, but I think the data is something like that. Anyways, so there's a lot of decay. This decay matters because if you are long puts on Friday, you are getting face kicked today. I think that is the operative term because those puts are dying of vol getting crushed, and now the market is rallying, and so those puts bleed out. And guess what? Now you have this reflexive feedback loop. Why is it reflexivity? Because puts lose when vol comes in, or when time passes, or when the market rallies. So what happens? The weekend passed and vol came in. Your puts are getting crushed. That puts flow in the market. That pushes the stocks up. That means your puts get crushed even a little bit more. And so at this point, the momentum is bringing us up until what? Until vol regulates a little bit, or until we have enough of a rally that volatility pressure dries up some. Those Greek impulse dynamics start to kind of dry up a little bit, right? So that is the kind of tailwind that we had here. Now, the higher you go and the more we sort of rally, the less interesting or kind of energizing are those dynamics. Now, what about this morning? And we did this live on Q&A with Scott Pulcini, right? So this is not a hindsight analysis here. But what we were talking about was, look, every day at around 9:40, 9:50, some group of jokesters puts in a big call spread or put spread, sometimes a condor. And the market loves to find those levels and then charge to those levels. And so when we were saying, we're like, all right, Scott, in a couple of minutes here, we're going to see this strike pop up, and all of a sudden you see the strike pop in there, right? And there it is, right? And so the market will tend to go to that level, and the confirmation of that is the HIRO indicator, which is the purple line. And the purple line is based off of real-time options trades. So when people buy calls or sell puts, the HIRO indicator goes up. And if you're getting billions of dollars of HIRO values going up, and you have the target to the upside driven by the intraday put call, look at Seek and Destroy algo on YouTube if you want to check this out. You have an upside target, very clear, also very big round number, so it's going to be on everyone's chart. Number two, you get the options flow finally saying we're going to drive to that strike. And then number three, the way we came into this market was look at these dynamics, vol crushing, time decay, et cetera, et cetera. So you see the Seek and Destroy now where we started around zero, obviously, in the indicator, and we're at $1 billion notional value of inflows into the S&P 500. And the S&P 500 inflows just continue until what happens? Until we hit Seek and Destroy level 6,700. That is a 99th percentile strike, meaning 3 levels down, 3 lines down, you see 99.06. If it's above 99%, that generally means it's a very, very large strike. It tends to be the strikes that the market wants to pay attention to. So let's say you don't know anything about gamma, volatility, any of that stuff, where you go, what does this mean? Is it big? I hover over 99%. Okay, there's a target. Great. Purple line go up. Oh, great. Is it bigger than $1 billion? Yeah, it's 2.8 billion. Oh, great. Okay, I know where we're going. Now, to suggest that the options market is a driver of the market rally would mean that if this HIRO flow stops, right, meaning the purple line stops going up, then the market would stop going up. That would be the indicator, right? Well, what happens today? The purple line stops when we hit the level. So it's like all this buying flow has to get the market to that strike, and then it turns off. We just shut off, right? So options flows in the driver's seat today. Now, for the rest of the day, what do you want to see if you are wanting to remain bullish? You want to see positive gamma start to come into the market. The problem is right now, as we sit here at 12:15 Eastern, where are the put sellers? Where's the negative gamma? Where's the positive gamma? Positive gamma would create blue zones on our chart. I would love to see this whole area down here filling in with rich purple. Purple means people are selling puts. That adds stability to the market below. We're not yet seeing that. So I don't love that. But in the absence of a catalyst, not rumors and innuendo, which is so far all the selling is based off of, like OpenAI may be dead, or AI may be dead, I should say. There may be a credit crisis. There may be Michael Saylor liquidating. There may be Fed rate cut issues. I mean, now we're leaning back towards a cut instead of 50-50. Like everything is a maybe, 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 maybe. It's not like, oh, this bank is screwed. It's going under. It needs a bailout, right? We haven't realized any issues at the moment. So in the absence of that catalyst, then it's unlikely that vol can get back to where it was last week, right? Because the momentum is now lost, and a lot of that downside momentum was, or upside in vol was due to the downside momentum. So now the all else equal, if HIRO, as long as HIRO stays sideways, which is the purple line, then I'll expect us just to sort of revolve around this strike, the big 6,700 strike, and we shouldn't expect a whole lot else out of the market today. Now, there's so much zero DT flow in this market, you have to watch HIRO to make sure that we can project that forward. But ultimately, the bulls are now in control for this week because of vol coming in and time decay. So if you want to short the market because you think this whole thing is just a Ponzi scheme, then I would wait until Monday, a week from today maybe. Then you may have a little more energy. Also, you have less put decay. So why do I say all zero DTE? This is HIRO. We just updated HIRO a couple of weeks ago. And what I did here is pretty interesting. This is the HIRO indicator for just the HIRO indicator, right? So many of you are used to seeing something different. And what I did here is I applied an EMA cross, so 10-minute versus 30-minute cross on the HIRO indicator itself. So these candles are not the price of the S&P 500. It's actually the HIRO indicator moving. And so you can see here is you can lay this out in such an interesting way now that you can follow HIRO as a trend, which I think is really valuable. And so when I zoom back on this, you see where we opened, right? We had some digestion of some initial positive HIRO flows, but the orange line, which is the 10-minute EMA, stayed above that green line, which is the 30-minute, and that just helped us stay with trend. And now the trend, you can see these little pluses because this is the EMA cross in our indicator, has really just sort of planed off. So it's like the easy gains are made, and now we're just sort of trending sideways. Like that all makes sense. Now, what is interesting about this is that if I add on the 0 DTE, we can look at this in a couple of different ways. So that moving average cross, if you're a SpotGamma subscriber, you know how to go and check that out now. I think it's pretty cool. So I'm going to delete the moving average because I just want to show how everything basically is now just 0 DTE. We're all aware of that at this point. But let's put some interesting signals on this. This is the S&P 500 basket. I say most is all of 0 DT flow, right? Purple line is all expiration flow. Teal line is just 0 DTE, and the candlesticks is now the S&P 500 price. 5 billion positive inflow. That's very big, 5 billion, especially for 12 o'clock in the afternoon. Number two is these two lines parallel each other almost perfectly. There's a little bit of a separation between purple and teal, which tells me that there's a little bit of all expiration put flow, all expiration options flow coming in. In a perfect world, we see a ton of put selling, either people closing out downside or put shorting, which adds positive gamma for dealer flows. We can break this down. So a lot of that is 0 DT. 4.4 of the 5.1 is S&P 0 DTE, and I can see that on my indicator here. But let's just break this down and say how much is puts and how much is calls. Put selling is the dark blue, right? So let me make this a line. Okay, dark blue is all expiration puts. That is the number one highest line on the chart. That means from a notional value, what is leading us higher is all expiration put flow, followed by 0 DT puts. So selling today's intraday puts was a very popular way to get long delta, and that's followed by all expiration calls in orange and 0 DT calls. So take this away, Brent. Another thing is you want to see put selling as a signal of stable market or a stabilizing market, and that's what we're getting today, right? S&P up 1.37%, VIX is down, vols down, all that sort of stuff. Who could have possibly seen this coming? So this is the nice thing about options too, is you think the setup is there, and then you can make a really cheap bet, right? So you don't have to go all in. What about single stocks? So this is particularly interesting. Look at the separation here between all expiration flow, the purple candles, and just this Friday. It's almost double into all expiration. That's very bullish. And if you look at the breakdown of puts and calls, it's a lot of call buying in particular, which is the green, right? Now, what I think is also a tremendous signal in this market is how strong Google is right now. Sam Altman made comments last week about Google eating their lunch and blah, blah, blah. And so, not Huli, Brent, but Google. 117 million of inflow into Google. You know, that's pretty big, though. It's not like record. Goog, 178 million, big, not giant, but still pretty strong. And then we have, of course, the names like NVIDIA. How's NVIDIA doing? A lot of inflows in there, 128 million, but it can be as big as 2 billion. So it's not like blowing my socks off. Tesla, huge, 1.3 billion. Really the leader here is this stock. Hard to argue that thing is not on its path to breaking out. So when you sum up the 3 billion, about half of that is Tesla, and then there's a bunch of other names, but it's the longer dated flow that's a good look at, right? This suggests that there are people buying this dip, not playing for this week, playing for next month, right? When the put lines go up, that signifies put selling Fibonacci whale, because we're measuring the delta of these trades. So if we think it's a sell, then that means if you sell a put, that's a positive delta trade, meaning dealers have to buy stock to hedge that position. That's the theory, right? So if you buy call, positive delta trade. If you sell a put, positive delta trade. So those are just bullish, indications, and you don't want to fight this flow. You may not agree with it, but you don't really want to short into all expiration positive delta flow at 3 billion. It just, generally speaking, from my experience, is not, the forces against you. So If you are finding this interesting, again, go to spotgamma.com/Black Friday, 75% off alpha. You could have had the alpha this morning and already made your money. You knew about 100 lot of spiders could do that. Yeah, so at the end of the day, what does this mean? We walk through this and we try to make it as simple as possible, right? So if you're new to this and you go into and you read our founders notes, we talk about a lot of the dynamics of what we're seeing under the hood. And this is admittedly a little bit more sophisticated. If you're new to options, you can be like, not sure what to do about this. I have a lot to learn. Great. But we have a lot of banks and hedge funds that read this as well. And a lot of our subscriber base has come accustomed to the Greek lingo. And so we bring everybody up, or we try to bring people up to that institutional level of understanding. But we also simplify it. We go, look, if you can't understand this, right, then you probably shouldn't be trading, I would argue, right? Lean long above 6,600 with a short-term target of 6,700 tomorrow. I can't really be more clear about that. So what do you do with that? You buy spiders, you buy S&P, you buy futures, you buy calls, you buy short, whatever it is, right? That's as simple as it can get. So there's always that statement that tries to make it very clear. We also keep a rolling summary of our notes. So anytime I give an update, I keep it here. And then after the note becomes irrelevant, I cross it out and I leave it there. Sometimes I'm wrong. I still leave it there so that you know what I was thinking a couple of days ago or what the dynamic was into this event. And I try to make this as simple as possible. So now that we're at 6,700, we got to start thinking about what could be next into tomorrow and et cetera. So that is that. Now, when you actually say, okay, we understand it was about 6,700 and you start to look at the way that the market was unfolding here, you wait for a big strike to come in. You'll see, look at 0DTE here, and I zoom out. You go, okay, it is now 940. There's a giant strike. And is HIRO going up? If HIRO goes up by the tune of 1, 2, 3 billion, then I know the target. I have the target. The flow, the options flow is moving up. VIX is coming down. VIX going down is generally going to tell you market goes up. HIRO going up tells us people are buying calls and selling puts. Great. What's my target? Well, it's a giant target sitting right there. So the pieces are easy to put together, especially once you watch them for just a couple of days. You'd be like, this can't be true that this just happens like this over and over again. It's like, no, it turns out it is. So, yeah, let's take a look at the NASDAQ HIRO for Maddie. Now, we tend to watch the S&P, and Trace is only available for the S&P 500 at this time, but you can also look at the NASDAQ. So here's the NASDAQ. I just added the NASDAQ tabs. I can watch it. You got $1 billion so far in NASDAQ flow, more all expiration flow than 0DTE. So that's a bullish indicator. And this NASDAQ indicator combines NDX plus QQQs. If you trade NASDAQ futures, you do not want to ignore the QQQ flows. They are huge, oftentimes bigger than the NDX. NDX tends to be chunky. You get like, it's a giant, obviously notional value index because it's 24,000. So the order flow in the NASDAQ can be a little chunkier, where the Qs tends to be more consistent in terms of the flows that we're monitoring. And so you can see there $1 billion so far of inflows. But the overall trend here, as the NASDAQ hit around 20, just kind of under 25,000, is we've cooled off, this afternoon so far. So the question is going to be, is there something that raises us to stage 2 for today? And that is going to come from one of two reasons. Number one is there's a bunch of flow up here at 6750. That's a big strike, right? Non-zero DT strike. So we're watching that one. That was one of the things we talked about for tomorrow into Wednesday. Number two is I'm watching HIRO. If HIRO continues to just go up and up and up and up, I don't want to fight that, right? So then I will say, okay, the new level has been unlocked. Right now, if I was long, I had this swing long from this morning. I closed out at 6,700 in full disclosure. I still have on December call flies per the note. That's a December play, right? Because I think we could ultimately rally back to 7,000 based on the flows, a cut, et cetera, et cetera. So I wanted to hedge out that risk. So there's that 1x2 that I described in the Friday Founders Note. But as an intraday trade, we put together all the trades based on what we wrote in the Founders Note this morning. So I'm sitting here flat. I don't want to short the market because HIRO's not going down. There's admittedly no support right now below, right? This is all negative gamma. The map is all red, which says that if HIRO rolls over and Trump says, some tweet that's just like so-and-so's a jerk and the world's over, like we're not trading with anybody anymore, whatever. Boom, market goes down. There's no support. I don't see anything. There's no positive gamma on this map at all, anywhere. Like OPEX cleared it out. Maybe down here 63.50. So to give you an idea what the difference would be, look at 11.17, for example, right? And you just look at the middle of the day at 11.17. See, there's all this blue here, right? Purple, positive gamma support implied at 6,600. Resistance, and these aren't heavy levels of gamma, but you can see relative purple on this map. We don't have anything right now, which just tells you that the downside could be fluid as well as the upside. The only reason right now that you're like, well, upside should be capped, to being honest with you, is this spread, right? And you look at net OI, that's 14,000, 15,000 dealer short calls at 67.05. And then you can see they're long about 6,000 calls at the 6,700 strike. So that's that kind of like penny stagey level. So the question in my mind is like, well, at the moment, you know, do I worry about market maybe breaking out and I'm not fully participating? I only have like a little bit of call exposure on. Do I worry about downside? Not unless this purple line rolls over. But right now you're fighting. That's the single stock flow. That's the equity flow going to trend higher. And then obviously you're getting a big gap here now in HIRO itself, right? So you want to be aware of those dynamics. Tough market to be short if that is what's staring you in the face, right? So that is something to be aware of. One of the things that comes with all levels of calculator, all levels of SpotGamma, again, Black Friday deal, SpotGamma.com/Black Friday, 65% off. Yay. Let's look at a put. So we say, let's check out the spiders. And let's say you are long a put. All right, so this is what our calculator looks like. And if you load up a 25 delta put, that's about an average put from where we are now. So I'm going to choose the 645 strike BC delta. So that's about the 25 delta put. That's great. Okay. Now we just launched this a couple weeks ago, and the reason it is better than any other calculator I've seen out there is because you can adjust implied vols in very unique ways. So this is what this put looks like today, and let's just say it is 12-1. So we get through the holidays, and I still have this put. What does this damage look like to me so you can visualize, in theory, what the put cover would have to be? So I'm going to bring up the implied vol settings. Now, this is off of today's IV. Today's IV has already dropped a lot, right? But look at that put skew. It's still way up there, right? The implied vol is moderated a lot, but let's say we lose another 2 vol points, okay? So now you can see that red line drops down. And then the other dynamic, this is where the cool stuff happens, is that put skew is likely to flatten out as people go, oh, I was wrong. So I just flattened out that put skew a ton. See that? And this will change the dynamic of the put value, right? The value of my position. So critical thing to note here, right? So I'm going to hit save. Now I am more accurately, arguably, pricing in the puts. And why does this matter? Because what you see here is, and if I zoom in on this, what you see here now is an arguably more interesting representation of the value of this position. So what you see is the dashed line is what the market P&L is, and the purple line is my IV adjusted, skew adjusted P&L. So I'm getting a different mark. And you may say that doesn't look like that much of a difference, Brent, but at 680, let's go to 670. That's 50, it's $100, right? Which if you thought you were going to lose $270, but instead you lost $375 on a percentage basis, that's a much bigger loss, right? That $100 is what the put people are risk losing, not just from time decay, but when volatility comes in, right? And that is painful. It's painful to sit here while the time is passing, market is rallying, and vol is coming in, and then you're staring down turkeys. You may only be able to buy a Costco pie, which is only $6. That's all you're going to be able to afford for Thanksgiving if you just sit here and puts while the market is running away from you, right? I'm being hyperbolic. I hope everyone can afford a nice Thanksgiving. But that's the point, right? It's very painful. Now, this represents the hedging flows related. When puts lose value, you have to buy back stock, right? And up goes the market. And when the market goes up, because of hedging flows pushing the market up, guess what happens? Puts lose even more money. And then, oh no, we have to keep selling vol because the market's going up. And then the puts even lose, and then eventually the puts all kind of lose out, right? So that's the feedback loop that you're facing down. So you may be right in terms of the whole AI thing being a giant Ponzi scheme, and the whatever other K-shaped economy rate thing, yada yada yada. That can all be right, and you could be correct. But this is not a great window to express that view because the momentum is kind of going the other way. And then the argument is, well, is 10,000 a reasonable? Ignore that deal. That is not a good deal. This is the deal you want. SpotGamma.com/Black Friday. So the argument here is, can the market really bounce that much? Look at what has happened in the last month. I talked about this on Friday as well. You see the options-induced decline on 10/10 when Trump tweeted, but he tweeted into ridiculous call skews. Incidentally, the marketing team said that the best tweet that I had in terms of views was the one where I said, "You've been warned," and about rich call skews. And what's funny about that is you don't know a trigger's coming. You just know the options market is set to break something, and then you get a trigger. And it's like, oh, okay, great, this broke. So it is not about the guessing about the fundamental shift and this and that and the other thing. It's like the conditions are here for something to break. It's like dinner is, the dinner table is set. I might get dinner. Maybe. I don't know. The table wasn't set. I'm probably not eating, right? But anyways, market dropped 3%. OPEX hits, we clear things out. We're up 5% from that low. Then we do the same thing, right? Down 4%, up 3.5%, down 5%. So can we gain another couple percent to get back to those all-time highs, kind of like that? Kind of feels like it, right? No guarantees in this game. It's just that you can't price out that opportunity or that chance, right? And not surprising, look at the, Monday morning low here and kind of up we go, right? Clear out a bunch of puts with OPEX, and there's a little bit of a rally here. So again, without sort of the catalyst, you need to it's hard for puts to regain momentum. Now, the other thing is that I just want to bring up is one of the things that you probably don't see in a horrible death spiral market is one of the top stocks in the country, world, universe, arguably. There could be multiverses out there, but in our universe, this is one of the best stocks. It's making new all-time highs. So if you're a technician out there or one of those types of folks, then you would be like, probably never seen the market go to new lows when one of the top 5 stocks in the world just made a new high. And they're not part of the middle out, to quote Silicon Valley. They're not part of the NVIDIA OpenAI middle out thing. They're separate. And so you can see that stock's looking pretty good. Again, tomorrow it all could end, but right now it all looks pretty good. So when you see that leadership, it's just another thing to pay attention to, in my opinion. That speaks to maybe more of a rotation as opposed to something else. Yeah, Big Pig is saying if John Williams doesn't say we can cut this entire different conversation. And Pied Piper, yeah. It's a funny thing though, right? Big Pigs, because you hit these situations where the rate cut odds had slid 100% and things were looking pretty weak, 100%. But what happens then? The puts get cleared out, right? And when the puts get cleared out and then you hit the weekend and no more bad news comes in over the weekend, we're in this window. We could very well rally this week, and then on Monday, it all sucks again, right? There's no, I don't make any prediction about that. Now, because he did say that we're expecting a cut, and if you look at the CME Fed Watch, right, you can see this if you compare. Things were looking bad in terms of the cut here, right, last week. And then suddenly they're surging rapidly in favor of the cut, right? So 100%, that is a tailwind for the market. And that really did allow vol to crunch down. 100%, right? So that totally makes sense. Now, the other thing is, let's say he didn't shift. Do you want to buy puts when VIX is at 25? Into a weekend, if anything, you want to sell it, and into OPEX, you have to roll your puts, arguably, right? So what does that generally mean? If my put's in the money, I'm gonna sell it and I'm gonna buy one that's farther down and out, right? So that relieves some of that hedging pressure as well. So some of this is also just, I think, about the momentum of things. And obviously it's easier for the market to rally with this rate cut now going the direction that people seem to want it in. But all that aside, the dynamics of vol is very rich. It deters people from buying puts. This note written here, timestamped 7 in the morning with the call fly, was before Williams said bupkis. So that is the thing, and I just want to leave this with one last thing, is that everything is an if-then statement, right? You can make your best projection about what you think is going to happen based on all the dynamics. In full disclosure, this call is looking good. I thought that we would have a stronger rally into the market, generally speaking. Let's talk about Thursday, for example. On Thursday, I thought that this market was looking pretty good. So this was an NVIDIA reported, and we thought that these dynamics of volatility, contraction, et cetera, should lead the market higher. So this is Thursday morning after NVIDIA wrote, right? Or after NVIDIA reported, excuse me. And this is what we wrote. We said, this isn't feeling all that stable. Gamma is negative across all strikes. You see there's this positive gamma above. And so we're saying, look, we're going to lean long as long as we remain in our safe zone. Our safe zone was above 6,700. So above 6,700, we want to lean long because of the dynamics that are driving the market higher today. Where we're wrong is if the market breaks, in this case, it was under 6,700, because that tells us that the risk is off because the dynamics that are feeding the market higher are breaking and going to move the market lower. So the market started off very strong this morning, and then at 10:30 in the morning, things rolled over and we saw $10 to $13 billion worth of negative delta coming in the market, and the market just dropped like a rock into the 6,500s, right? So we go into this saying, this is what we expect. This is where we are wrong, right? This is where things break. This is where we're getting out of Dodge. These are the two levels. So, you're not going to hear me sitting here saying like, hey, we called this thing because when it went under 6,700, it was like, oh crap. They're all if-then statements. Sometimes we lean one way, sometimes we lean another. So that's the full disclosure of the statement. And it's the same thing about this morning, right? The thing about this morning is this looks good as long as we remain above this level. And that level is specific to when we break below that level, then you get volatility going the other way. Gamma can drive us down, the lack of support, yada, yada. So you get these, you have these if-then statements. It's never just sort of like you have to buy stocks now because trade deal makes the economy better and taxes on tips and blah, 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 and yada, yada, yada. It's like, these are the if-then statements, and flows should go this way. This is where we are wrong, and you want to watch out, right? Because that is the thing. You need to know when to mark your thesis as incorrect. And so we try to give those two-way levels. And we do give the two-way levels all the time. A lot of times it's a neutral feeling, though. You don't have something strong to lean on. And again, this rally is more about time frame right now, right? This next week, through the holiday period here, being, into this window, right? Time and price window is bullish window closes in and around here. And then if we start to look at the volatility space and say, what's the next thing that the market thinks is interesting? Well, let's look at this. If we bring forward implied vol into the mix, forward implied vol is going to show us where volatility is actually elevated. And there's two areas in here. You get JOLT data, looks like it's causing a little bit of consternation for next week. PMI, the normal rolling data. I guess this should actually be real data for once, as opposed to like some delayed kind of nonsense. So that could be interesting, impactful to the December rate cut situation, which is what's being priced in here, the 10th, right? See how that forward implied vol is so elevated? So we know now that for this week, look at that forward implied vol. It basically doesn't exist because of the holiday and no major data coming out. And then we are really going to turn our eyes to next week's on the cyclical, monthly data puke of JOLT, PMIs, NFPs, whatever else is going on there. And then you have the big FOMC, and then Oracle is going to report right in around this window as well, which is likely to be, a major thing to pay attention to. So this is verifying that this week is kind of like, who cares? 0DT people can play, a little short-dated short vol people can play. Then we'll get some data next week where maybe that'll start to upset the apple cart. How much of the flow do you think is controlled by large market makers? There's 4 or 5 major market makers out there. So I would say 75% of it, just guessing. Citadel at one point a couple years ago said they did 45% of options flow by themselves. And Jane Street, Susquehanna, those are big firms, big outfits. Optiver, so there's a couple of really big ones. Wolverine. There's it's the 80-20 rule probably. 80% of the flow is handled by, not even 20% of the biggest market makers. The problem with new market makers now is it's a huge moat from a technology perspective. Would you want to try to build technology against like Ken Griffin? I would suggest Big Pigs. I don't know who you are, but I'm guessing you don't have the capital to mess with that. And then number 2, the compliance is just ridiculous. So if you want to try to you just want to try to open the business, the number of hoops you have to jump through is insane. So you get those legal compliance costs just before you can even get your technology going. So I honestly think that's why a lot of smart people go into crypto market making, because they know to make markets just easier to spool something up over there. I can tell you that the hoops we have to jump through as data providers it's just getting to be bananas. So anyways, that keeps the market making pool kind of thin. So these are the dynamics. Let's just wrap this up here as we get to the top of the hour. Number 1 is this purple line keeps going higher. Maybe you don't want to get long this. You definitely don't want to short it, in my opinion, when this purple line just keeps going up. If that purple line, the HIRO line, stops going up, it's now $6 billion. It's $8 billion from the low. This is just flows coming in. Vol keeps coming down. It's a dynamic that makes it challenging. And you watch this 6750 now as we start to digest this 6700 level, right? That's the thing to watch for. If HIRO rolls over and starts to puke, okay, then maybe shorting makes sense. But right now, hard to argue that. So 6750 is the next obvious strike with a lot of flow sitting there. Number 2 is the single stock flows are really quite interesting. We talked about Google this morning as a winner. There were some big strikes at 310. Clearly, that's gotten steamrolled by new flows. These are longer dated flows coming in, so that one looks good. Tesla looking really good this morning, $1.4 billion worth of inflows there. You flip through some of these other names. Meta actually looking very good here, $400 million. It's a record now, 30-day record for them. Longer dated flows coming in again. So there is some what looks like re-entrenchment into this AI narrative now based on the flows that we're seeing. We're going to really want to watch synthetic open interest, which is our custom proprietary. We call it also SpotGamma I, the SpotGamma SGOI. This shows you where funds are positioned. So this is big negative gamma to the upside in Meta. From a positional standpoint, this could be very violently upside into this 700 strike. If we look at Tesla, the dynamic is a little bit different. There's a little bit more positive gamma, as you can see here, that would generally infer that you'd have a little bit of tighter movement. But we're starting to get into this peak gamma area around 430. So this actually is supportive of the stock. I would think that it wouldn't move so much, but you're getting $1 billion worth of inflows, which is moving that stock. And then here's Google. Here's the 300. Here's the 310. So this 310 is support now. Over that level, you get negative gamma again, all the way up into this 340. Above 340, the positions really thin out. I imagine with some of the flows today, we'll see some of the shift, but using 310 as support and remaining long in that stock at the moment just makes a ton of sense. And then certainly last but not least, you can look at my face for a second where I bust out Flow Patrol. Flow Patrol we launched in August, I think it is. The reception of Flow Patrol has been nothing short of incredible. And if you sign up for SpotGamma, you get access, SpotGamma Alpha, which is part of the Black Friday deal. You get access to Flow Patrol. What is Flow Patrol? It tells you the biggest changes in our SpotGamma buy-side positioning. Buy-side is hedge funds and retail, right? So the SGAI positioning. And this is analyzed and written by by AI. So this is an AI-driven report. It analyzes all of the position changes on a daily basis, and it gives us a synthesis of exactly what changed and why we should pay attention. One of people's favorite tables for good reason is unusual options flows. So if you scroll down here, we have tutorials on this and everything else, but this comes into your email every day. This is the unusual options positions. And what is cool about this is you can start to break down and see what are people doing. So we look like a call spread. This may be a call fly. I'll have to check that one. 175, 180 call fly in VRT. I don't know anything about this name, but that is some pretty sizable buying to open, $9 million bucks. What's going on over there? Ehang Holdings. What is this? I don't have any idea, but someone just put up a pretty sizable $10 million bet, roughly. And that's for January 2027 calls. Longer dated positions coming in. Me likey is the quote. What else is interesting here? Bristol Myers, 8,000. That's about $2 million. So, who's putting $2 million up? It could always be a hedge to some other position, of course. So you don't know specifically what the driver was, but you look at some of these things. Beto, $1.5 million. The Beto is a Bitcoin related name, obviously. So it's pretty sizable. Datadog here catching a bid or some buyer, $1.8 million worth. So a lot of interesting positions there. This thing is one of the more interesting things I've seen in a while. So given that stock has just been getting nuked, might be worth a copycat trade, for example. So we will keep an eye out on that one. Again, if you sign up for SpotGamma Alpha, you get access to the report. It comes out every day. A lot of interesting trades in there. So go and check that out. So as we wrap this up, go to spotgamma.com/Black Friday, and you can get access to Trace, HIRO, Flow Patrol, subscriber Q&A, which starts in 10 minutes. I'm wrapping this up so I can get my voice a rest so we can launch in again for SpotGamma Q&A where you can ask more questions, get more access to the SpotGamma community. So that'll be a lot of fun. We'll try to sync up with some interesting ways to express new trades into the end of the end of the year, end of the week. What's the best risk reward for the week? We'll answer that question maybe in about 10 minutes with SpotGamma Q&A. So if you like this, join now, spotgamma.com/Black Friday. You get access to the Zoom link for the 1 p.m. Q&A. You also get access to, again, HIRO, Flow Patrol, Trace, Calculator, a giant repository of training materials and analysis, all that kind of stuff. I can make more Costco pie jokes as well. So spotgamma.com/Black Friday. Hope to see you all there. Hope to see all of you in 10 minutes. And that'll be it. Any questions, info@spotgamma.com, and you will get a response. Toot sweet. All right, everybody. If I don't talk to you again, number one, it's disappointing. Number two, enjoy your Thanksgiving. Enjoy the markets. Good luck trading, and we'll see you.